Welcome back to the channel. Today, we're analyzing GE Vernova Inc., a major player in the energy sector with a market cap of $101.42 billion. With solid fundamentals, a strong cash position, and steady revenue, is this stock a buy, hold, or sell? Let's break it down step by step. GE Vernova has 275.90 million shares outstanding, increasing by 1.46% over the past year. A controlled increase in shares can be good for expansion without over-diluting investors. Caution: however, the stock is trading at a trailing PE ratio of 65.88 and a forward PE of 60.21. This is quite high compared to the broader market, which means the stock is priced for future growth. The PEG ratio of 2.08 also suggests the stock may be overvalued relative to its earnings growth. Investors should be careful with such high valuations. Unless earnings grow significantly, the stock may struggle to justify its price. Enterprise value and profitability. Caution: the company's enterprise value, EV, is $94.27 billion, with an EV/EBITDA ratio of 40.72 and an EV/FCF ratio of 55.46. These are very high numbers, indicating that the stock is trading at a premium. Generally, a lower EV/EBITDA, around 10 to 15, is considered attractive. Investors should only buy at such a high valuation if they strongly believe in future growth. On the bright side, GE Vernova has a current ratio of 1.08, meaning it has enough short-term assets to cover its short-term liabilities. A ratio above 1 is generally a sign of financial stability. The debt-to-equity ratio is just 0.10, meaning the company relies very little on debt, which is a strong positive. In uncertain markets, companies with low debt tend to be more resilient. Revenue and earnings. Positive. In the past 12 months, GE Vernova reported $34.94 billion in revenue, with a net profit of $1.55 billion and earnings per share, EPS, of 5.58. Revenue growth is always a positive sign. Caution: however, the company paid $939 million in taxes, which means a significant portion of its earnings is going toward tax expenses. This is normal for a profitable company, but investors should consider how tax rates affect net income. The return on equity, ROE, of 16.43% and return on invested capital, ROIC, of 7.37% show that the company generates decent returns for shareholders. A high ROE is a strong indicator of financial efficiency, cash position, and debt. Positive: GE Vernova holds $8.21 billion in cash and has only $1.06 billion in debt, meaning a net cash position of $7.14 billion, or $25.89 per share. This is a great sign, as a strong cash position gives the company flexibility for expansion, acquisitions, or handling downturns. Margins and free cash flow. One area where GE Vernova struggles is its profitability margins. It operates with a gross margin of 18.46%, an operating margin of 3.58%, and a profit margin of 4.44%. These low margins indicate high operating costs. While revenue is strong, the company needs to improve efficiency to boost profitability. On the cash flow side, the company generated $2.58 billion in operating cash flow and $1.70 billion in free cash flow after deducting $883 million in capital expenditures. A positive free cash flow, FCF, is a good sign because it means the company can fund itself without needing external financing. Short interest and analyst outlook. Caution: the stock has a short interest of 5.16 million shares, meaning 1.87% of outstanding shares are currently shorted. A moderate short interest suggests that some investors are skeptical about future growth. Analysts remain bullish, with an average price target of $373.13, representing a 1.51% upside from the current levels. The consensus rating is buy, which means analysts expect the stock to perform well over time. GE Vernova does pay an annual dividend of 25 cents per share, but the dividend yield is only 0.07%. This is very low, meaning the stock is not attractive for dividend investors. If you're looking for passive income, this may not be the right stock. If you're looking for a stock with high growth potential and strong fundamentals, GE Vernova could be a solid pick, but at the current valuation, it may be risky for value investors. What do you think? Let me know in the comments below. And if you enjoyed this analysis, don't forget to like, share, and subscribe for more stock insights.